SoFi stock is rocketing higher after the news that they received regulatory approval to become a national bank. What does this mean for SoFi, the business? What does this mean for both potential and current shareholders in SoFi stock? If this is your first time tuning in, my name is Daniel, and you're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in SoFi, though I'm watching it closely. And so yesterday after the close, SoFi announced that the Federal Reserve had approved its application to become a bank holding company via their proposed acquisition of Golden Pacific Bancorp shares, which is expected to close in February. As Anthony Noto said about this milestone, with a national bank charter, not only will we be able to lend at even more competitive interest rates and provide our members with high-yielding interest in checking and savings, it will also enhance our financial products and services to ensure they efficiently meet the needs of our members, business partners, and communities across the country, while continuing to uphold a high bar of regulatory standards and compliance. Yeah, this does broadly fit into their, mandate to become this everything finance app and being able to more easily offer checking and savings accounts where they directly benefit from those deposits. Okay, so what is the actual impact, and what should we think about it from a fundamental perspective for shareholders? So in order to understand the potential impact, let's actually take a step back here and understand management's projections from early on, back when they were a SPAC. So this was one of SoFi's first presentations, which showcased the following outlook. By 2025, they expected 32% EBITDA margins based on adjusted net revenue of around $3.7 billion. That's up significantly from their current outlook for 2021, which is around $1 billion in revenue. And so this chart pencils out a nearly 25% uplift in EBITDA in 2025, with the following assumptions I've highlighted in yellow. It's always important to read the footnotes about a 2% reduction in cost of capital, a 6-month balance sheet hold period, and moderate growth relative to baseline lending originations. What's that all mean? So what this means is that having a bank charter should allow them to take on deposits, hold more loans on their balance sheet, and increase their loan originations. And so it effectively gives them greater capacity to write business. So that should result in an uplift in their business, and it could potentially result in a lower cost of capital. We'll see. I mean, they recently just did a convertible note, I believe, that was at effectively a 0% interest rate. So it's hard to lower your cost of capital when you're issuing bonds at zero. Now, that was does convert into the stock price at a much higher price. So, these are data points to consider. In this hyper-competitive environment, it's not like you can really offer super high yield checkings and savings accounts. What you're really talking about is probably, under 0.5%. And that would be significantly higher than, let's say, the mega banks. So that is a worthwhile point to consider. A good amount of this uplift will flow through the top line. The reduction in their cost of capital or interest expense, that will not be top line, but growing their business by holding their loans longer or being able to write more loans should flow through their revenue. So maybe it brings their EBITDA margins from the 32% that they were projecting by 2025 to, let's say, mid to high 30s by 2025. This is just penciling it out, how to think about it. And it's important to remember that their EBITDA figure needs to be adjusted when you start thinking about actual profitability of the business. It's always nice to talk about pie-in-the-sky figures, but what actually drives the core value of a business is its actual free cash flow, its true profitability. So once you factor in stock-based compensation, depreciation, amortization, and interest expense, you could argue whether or not D&A should be added there. I suspect that they're going to be making significant, capitalized software investments, so maybe that's a net neutral. But when you factor these different expenses in, the true operating profit might be closer to 30% versus, let's say, the 30 to 40% EBITDA margins that they're talking about. So maybe 30%, maybe mid-20s. That's how I'm personally thinking about when I'm looking at this valuation. So what's the updated valuation as we consider this? First, a quick plug. If you're interested in joining a community of fellow investors looking to learn and find exceptional companies, we have an exclusive community on Discord. You can sign up at unrivaledinvesting.com, click join the journey. I also call out potential multi-baggers and share my own personal portfolio for those interested. Once again, that's at unrivaledinvesting.com, click join the journey. And if you enjoy videos like this, please make a point of hitting that subscribe, hit that thumbs up button. And so thinking about the valuation. So first, while it's nice to see a projected 30% profit margins in the next few years, 2025, the reality is that they've still got a lot of growing up to do. The only reason why they're remotely EBITDA positive now is because they have a massive stock-based compensation that gets added back. You can see in the third quarter 2021, $73 million in stock-based compensation. Year to date, $163 million stock-based compensation. At the end of the day, SBC, or stock-based compensation, is a very, very real expense, and so it should be considered when you're thinking about the true operating profit of a business. And as a prospective investor in SoFi, I'd like to start seeing some real operating profitability in the coming years, real profitability, in order to further validate their business model. So in order for shareholders to have an attractive return from here, recognize the stock price is currently around $14 as it's ramped up a bit following this news. They'll need to see continued execution, in my opinion. So far, management has been delivering, though. You got to give them full credit for that. But we'll need to see continued hypergrowth and significant profit margin expansion, real profits after stock-based compensation and interest expense, and maybe 25 to 30% profit margins. That's sort of what they're alluding to, real profit margins. Now, of course, stock prices can go way higher or lower than a hypothetical valuation framework that I'm penciling out, as it depends on execution and sentiment. That said, if management delivers and the market gives them, let's say, 35 times earnings multiple 5 years out, there could be several 100% upside, especially if they're able to keep growing at a hyper rate. I'm assuming in a high case scenario. Keep in mind, this is thinking about what are you playing for in terms of upside. This doesn't reflect, how bad the downside could be if they misperform, if they underperform or have very poor execution. If there's poor execution, then the stock price could go way worse than this hypothetical framework that I'm penciling out of, effectively like break even on this low side. And so looking at this, thinking about, okay, what am I potentially playing for if they compounded 40%? And you get to 35 times earnings multiple, and they're able to actually get or be valued on 30% operating profits 5 years from now, then you are talking about several 100% upside. So that does get people excited. Ultimately, looking at all these different data points, does having a bank charter increase their value proposition? Yes. Does it make them a potentially stronger business? Yes. Does it increase, their ability to do more business? Yes. So this is a good data point. This is the reason why the stock's higher today. It's not like it's up 100%. Folks said, oh, okay, it's been well telegraphed that this was coming. So that's the reason why it's not up like 50% on this news. It's, hey, this has been a data point, but now that you see it, you do see this uplift in the share price. Does it make them unrivaled, though? And that's the name of this channel. No, I'd argue not. They're still competing in a hyper-competitive world, and it's going to take some time where they build out their network to say, hey, now we're really successful with cross-selling various different products. When that happens, then they'll be closer to unrivaled. At this point, having a bank charter, they're competing with hundreds, if not thousands, of various different banks out there. But they are doing something special. I'd argue from the user interface perspective, the front end of trying to say, hey, we're going to be this super finance app where we've got you covered. But it's going to take some time before that actually translates into an unrivaled business model, because right now it's about spending a lot of money on sales and marketing to bring customers in, and that isn't sustainable long term unless they really start getting some significant operating leverage, because customers come into their super app and then they're able to cross-sell them to multiple different products and not have to spend that sales and marketing dollar again to sort of retain them. So that's the question mark. Can they become unrivaled using this sort of upselling, cross-selling approach in the future? And keep in mind, upselling, cross-selling, that is not new. Wells Fargo, honestly, that's what got Wells Fargo in trouble several years ago, is that they were effectively forcing customers to upsell even though they didn't or cross-sell, even though they weren't even wanting new accounts and things like that. So this is not, a new approach in terms of cross-selling, but their approach of having an everything financial app is potentially new. And in full disclosure, I haven't talked about, their Galileo segment, which is growing very quickly and is a critical backbone for several financial apps. So that does is a special part of the business. But I'd say the crux of the business, as I've called out before, is really their lending business at this point. Given that it's a significant size and way disproportionate size of what contributes to their contribution profit. So I'm looking at SoFi. This is a company with great potential, and I look forward to tracking it and maybe owning it someday as they further prove out their core operating profit. Clearly, the company, has been on a wild ride. I'd argue does have several 100% upside if management continues to execute. I look forward to watching them play out. I enjoy watching these milestones happen. The news about becoming a effective bank, getting that bank charter, is a very favorable development. So I'd like to see them continue to execute and operate. If this is your first time tuning in, please make a point of hitting that subscribe, hit that thumbs up, and I'd love to hear your thoughts on SoFi. So please leave a comment below. Thanks so much for tuning in.